Hi, everyone, and thank you so much for joining us for From Capital to County, State and Local Tax in Focus as part of our last but certainly not least series in our Tax Horizons Planning Ahead After the Reconciliation Bill. My name is Michael Ronsky, and I am a managing director in the National Tax Office here at Cherry Beckert. And we have got a terrific series for you today. We're going to talk about how federal tax reform is influencing state level legislation, enforcement trends, and planning strategies. And I'm very pleased to announce our terrific panel of speakers. I am joined by Mark Arrigo, who is a partner and the state and local tax leader here at our firm. And he is joined by his colleagues in the state and local tax sector, Karen Boyaris, Peter Beisch, and Tony Conkle. So really got a great conversation coming your way today, and I am pleased to hand it over to Mark to go over the agenda.
Michael, thank you very much. We're excited to be here today. So I really appreciate everyone joining us. Let's walk through the agenda so we can get down to business. We're going to really talk about a number of things and what's driving things here. We are going to talk about state fiscal policy challenges, and we'll get into a little bit of detail on that. I'll actually cover that on that one. State conformity. And in this instance, conformity is going to really matter a lot. We're going to cover provisions impacting businesses, research and experimental expenditures, business interest expense limitation, bonus depreciation, some international provisions. We'll cover the ones and explain where we think that's going to impact on the state side. And that'll be done by a combination of folks up to there. Tony is going to come in and talk about the elective pass-through entity tax. And then we will talk about some of the other provisions, and Tony will cover this, impacting individuals. So we're real excited for this, and we do appreciate the time of everyone taking to join and participate with us on this. So let's move over to what is going to be the challenge here. And the challenge is a number of pieces here. States are required to have balanced budgets. And that's completely different than the federal government, which can just print money or can go out and, get it in different manners. So there are a couple of key things that are driving things here from the bill. And the reality is the Medicaid changes are really going to be an impact on the state side. And when you look at it, what's going to happen is we will see the provider changes that are imposing significant new limits on the ability of states to use and draw down on funds. Now, originally you look at that and you say, well, it's a piece of it, but there are federal savings in this on both on the Medicare, on the Medicaid piece. And then the reality is the estimate is it's $1 trillion over 10 years of total savings. So this is helping pay for the bill itself. And then, as most people have heard it, it's the Supplemental Nutritional Assistance Program, known as SNAP. And there's just a number of requirements. And starting in 2028, the states are going to be required to contribute to the cost of SNAP food benefits. And that's 128.3 billion. So we're not throwing around small numbers. States, again, have to have balanced budgets. And that's going to be a really important component. The next piece beyond the balanced budgets and some of what is looking like it's going to be pushed back to the states to absorb is going to be special sessions from legislatures. And that's going to be a real interesting piece. Not all states do annual sessions. Not all states can call special sessions. So what's today in front of us, we might not know what the answers are until a lot of the sessions go through and how that's going to unfold. Most states start with a number of key pieces here on conformity, and we're going to spend a little time on conformity and try to explain it in pretty simple terms. But conformity is going to be important as you look at how your state is handling the legislation. There are some expiring PTE elections that will have to be dealt with on the states through legislative in Illinois, Minnesota, Oregon, Utah, and Virginia. We would expect those to be, put back in place. So let's talk conformity for a few minutes. Most states, in case, start with federal taxable income. On the individual side, they start with AGI. So, and that's normally the starting point for most states. But what happens is how the states conform to the federal income tax code is really the key. And there's three terms you're normally will hear. It's fixed or static, and we're going to use the term fixed here, rolling and selective. And fixed is just what it sounds like. It conforms to the Internal Revenue Code as it existed on a specific fixed date. And there are a number of states that have that. Why do states like that? It provides stability. They kind of know what they're doing. However, there are changes enacted on fixed that are not included in the state law calculation. It just requires a lot of, they're going to have to go through from a legislative standpoint. The rolling is exactly what it sounds like. It's an automatic rolling adoption of the Internal Revenue Code. It's from an overall standpoint, it has simplicity to it. State law automatically updates when the federal Internal Revenue Code is amended. Then you have selective. And selective is states pick and choose which specific provisions of the Internal Revenue Code they want. It's a very precise and control matter that the state uses from a policy standpoint. And states just have to evaluate how they want to manage and go about adopting the Internal Revenue Code, the pieces, and a lot of it's driven on the policies, the budgets, and everything else that drives the states. So with that, I'm going to turn it over to my colleague Peter Beisch to really give some examples and bring this to life on the importance of it in some things that have just recently happened.
Yep. Thank you, Mark. And it's good to be here today with all of you. As Mark was just discussing, we're gonna see a similar pattern and theme here around state conformity, since that really drives a lot of the state income tax compliance and planning. So now we're gonna talk through some state action items as a result of the One Big Beautiful Bill. First up is California. State Senate Bill 711, which the slide says is with the state assembly. I believe this actually just got passed and was sent to the governor for signature. I believe it maybe even yesterday. If this bill is ultimately signed by Governor Newsom, which I don't see any reason why it wouldn't be, this will move the conformity date to January 1st of 2025. And since the One Big Beautiful Bill was signed after the state in July, California will not automatically conform to the federal law. For Colorado, there was a special session which was signed by the governor to deal with the budgetary shortfall that was anticipated in the state due to the federal legislation. As Mark alluded to previously, cuts to programs like Medicaid and SNAP will shrink the federal aid and shift some of those burdens and costs to the state level. So you will see more and more states responding to this as a result. The law does not conform to the One Big Beautiful Bill and was really more fiscally driven to address the budgetary shortfalls that are anticipated. So the bill contained a number of spending cuts and revenue raising measures instead of really addressing the underlying specific provisions in the tax policy. For Maine, Maine's law expressly decouples from certain parts of the One Big Beautiful Bill. From what I've read, it seems this was done in part to preserve the state's control of their budget while further evaluation is needed. So we'll see if further legislation comes forth due to this. In Rhode Island, which is a rolling conformity state, legislation was directed to include some revenue raisers like adjusting certain excise taxes and some other types of fees. And it also directs the Department of Taxation to do a thorough a review and analysis for the impacts based on the federal legislation. The goal is to address conformity really in 2026 from a revenue perspective, which will help the lawmakers decide which provisions of the One Big Beautiful Bill to potentially keep and decouple from. And then lastly, for Virginia, which was another rolling conformity state, they used legislation to pause their rolling conformity statute. And this was more budgetary in response than addressing the specific conformity issues as well. Similar to Maine and Rhode Island, the bill expressly directs the appropriations committees of both the House and Senate to review the impacts of the federal legislation. We are actually anticipating a lot of state activity over the next year, as this will likely be a focal point of each state's legislative sessions. Next slide. So here is just a quick overview and map of what the current state conformity looks like to the IRC. As you can see, this is pretty split between fixed and rolling conformity. Some states have some specific dates and rules, but we'll leave this up for a few moments so you can visualize it and see, potentially where your state falls. All right, we can probably move to the next slide now.
Thank you, Peter. And that brings us to our first polling question. How does your state currently conform to the Internal Revenue Code? Fixed conformity, rolling conformity, selective conformity, or not sure? And Peter, to your point, it's really going to be fascinating to see how states continue to react with this bill having just passed. Obviously, it's not just budgets that are in play, but taxpayer compliance obviously becomes much, much, much more complex as states continue to have differing sets of rules from the federal standpoint. And so, obviously, we're here to help navigate all of those challenges, but it certainly goes without saying that it's something to watch out for and stay in tune with.
Absolutely. Yeah, we're going to get into some of those compliance challenges in the coming slides.
Yeah, absolutely. So looks like most of our residents or attendees are residing in states that are fixed conformity or they're not quite sure. So looks like we're pretty spread across the board there.
All right. So, we're going to go through the key changes under the One Big Beautiful Bill that we're going to be addressing. And some of this may be a review to some of you that may on the call that may have attended other, federal webcasts and things, but we'll be addressing some of this from a state impact perspective. So on the corporate business side, we're going to be addressing the research and experimental expenses for 174 and 174A, 163J interest expense limitations, the expensing and depreciation provisions under 179 and 168, as well as the I-tax provisions around 951 and 951A. And then from there, we'll get into the individual tax changes, including the SALT cap and pass-through entity tax elections, Section 199A, and also some of the other items that did and did not make it into the final bill, such as no tax on tips, no tax on overtime, Public Law 86272, and some other items. Next slide, please. All right, so many of you on this call probably remember that the research and experimental expenses under TCJA were limited beginning in 2022, where these expenses became amortizable over a 5-year period on the domestic side, and 15 years for expenses that occurred outside of the US in foreign jurisdictions. And similar to depreciation, these expenses were also implemented on a half-year convention. So this was just a quick overview of what things looked like prior to the law change. Next slide. So what are the changes under the One Big Beautiful Bill? First, the bill brought back the immediate expensing of qualified domestic R&D expenses. The bill keeps the 15-year amortization for foreign expenditures, but restores the domestic expenses to be fully deductible. This was to help obviously incentivize more domestic expenditures and prevent companies from offshoring this type of work. Also, since these expenses can often be very capital intensive, it prevents handcuffing startups and manufacturers from monetizing these benefits through deferred deductions. So beginning in 2025, companies can start deducting their domestic expenditures again. I'll just call it OB3 because I've heard that as the term applied to the bill. For OB3, this also allows companies various ways to deal with prior year expenditures that were added back. For certain companies that meet this $31 million gross receipts test under Section 448C, these companies can go back and amend their federal tax returns to claim refunds. For companies that don't meet this small business receipts test, these companies can take what's called a catch-up deduction for the unamortized portion of the domestic expenses, either on their 2025 tax return or split them between their 25 and 26 returns through an accounting method change. The other option is to simply do nothing and just continue to amortize the previously added back costs. Next slide. So how does this impact states? Well, it's going to be centered obviously around conformity. Again, it goes back to that theme that I was telling you about. Previously, there were a number of states, I believe it was around 10 or so, that did not conform to 174 and allowed the deduction for those expenses that were added back for federal for 2022 and onward. And the other states just simply conformed to federal and had no modification. So tracking conformity now becomes a bigger deal because fixed state conformity states may have conformed to federal treatment and may automatically decouple from these new 174 provisions until the states either update their conformity or address it through the legislation. The various state treatments can create additional state versus federal tracking rules of the expenses as a result, similar to net operating losses and also 163J. Also, these state rules can impact 163J as well, since now you have different amortization calculations for state and federal purposes, which creates another layer of complexity. Next slide. So interest expense. For 163J interest expense deductions under TCJA, the interest was limited to 30% of the adjusted taxable income, and any limitation was carried forward indefinitely. In the first few years, the ATI used EBITDA, which included adding back amortization, which therefore increased the deduction that was available to companies. However, since 2022, ATI then switched to the EBIT method, which no longer allowed adding back amortization back to the base, which resulted in a more restrictive calculation and deduction. The One Big Beautiful Bill restores ATI back to EBITDA with some nuance updates around certain foreign provisions and income inclusions. This is deemed to help companies, especially early on, who may have a lot of debt or to fund startups or other investments and acquisitions and property, plant, and equipment expenses. So that was really the genesis behind that, is to help those companies. So next, we're going to see how this impacts the states. So next slide, please. So one of the major issues that was also seen during TCJA and still applies to the One Big Beautiful Bill is that there are a number of states that require separate reporting and don't follow the consolidated return regs. These states do not use the consolidated 163J limitation, but the specific subsidiaries limitation calculation. Also, for state tax planning, interest is already scrutinized by many of the separate filing states for intercompany interest and other things that require add backs. There are some exceptions related to these add backs for certain things like foreign interest that's paid, or if the intercompany party that's receiving the interest is also filing in the same state. There are certain conduit exceptions that exist, and there's other things as well. But the key point here is to realize that the states don't necessarily follow the same federal deductibility of interest, and that needs to be further analyzed. Lastly, due to the conformity issues we've discussed, you can land up with differences in EBITDA versus EBIT treatment for calculating the 163 limitation. The additional tracking for state purposes may be required as a result. Some states have also already decoupled from the original 163J rules and allowed full deductions. So it's important to navigate these issues carefully as you're approaching state tax planning and compliance, because there's going to be a lot more tracking likely that's involved until some of these states really work through their legislation. And now I'm going to turn it over to Karen to discuss asset expensing and the depreciation rules.
All right, thank you, Peter. And I would like to thank everybody who's joining us today. It looks like a really good turnout. So what I'm going to discuss are the various elections to expense certain business assets, discussing, obviously touching upon the federal treatment, because we need to understand that to know what to do with the states, and then kind of recapping in terms of how the states are going to be dealing with these issues. These provisions that you're probably all familiar with, 179 provisions, 168K, but those have changes, obviously, and then we have this new provision, 168N. So you have to kind of decide or kind of think about, how the states are going to address these issues. So for the 179 deduction, it was currently limited to $1 million, and it was reduced dollar for dollar to the extent that the 179 property exceeded 2.5 million. So there's basically a phase out. Under the reconciliation bill, for property placed into service in taxable years beginning after December 31st of 2024, that is increased to 2.5 million. And the phase out starts basically around $4 million. Now, what's interesting on the state side currently is there are a fair number of states that don't currently adopt the current 179 provisions. I think it's my count is it's somewhere slightly under about 20 states. And what some of them are doing is some of them, use like the really old threshold, which is $25,000. But, there's still a sizable number of states that don't currently adopt. And what will be, of course, the focus is to see as a result, of the changes in what the legislatures do, how will that number increase? And most likely it probably will. So if we want to go to the next slide, we're going to discuss the bonus depreciation provisions. These have obviously been around for quite a while. The TCJA, though, the 168K, put into place the 1,000 bonus depreciation, for a number of years, basically kind of the end of 2017 through 2022. And then it was supposed to be ratcheted down, so it would go, to 0% in 2027. But that is another change that, we're going to be seeing. This is basically for qualified property. It's tangible personal property with a recovery period of 20 years or less. Can also be a qualified improvement property, which are certain improvements to non-residential real property. The original use begins with the taxpayer. And if I recall, I think under the TCJA, they started allowing it for used assets as long as it met certain other criteria. And it doesn't include property for which the ADS method is required. And the other thing, for the bonus was taxpayers could elect out for a recovery class of property for any tax year. So if we go to the next slide, what it shows us is for qualified property acquired after January 19th, 2025. So that I'd say January 20th date becomes very important. So if you have property acquired prior to that date, but placed in service in 25, you're gonna be stuck with the 40% depreciation deduction. But if it's acquired later than that date, you will get that you'd be able to apply the 100% if you so elect and want to do it that way. And what we've noted is there's a provision that's saying that's property that's treated as acquired no later than the date on which a written binding contract is the date that's going to be used. And I would advise people to kind of consult with their legal counsel, because sometimes you end up with issues, for example, does a purchase order with acceptance, should that constitute a contract, which it probably does, and what would be the effective date of that? And then, as we've mentioned, there is an election to apply the 40% bonus for property placed in service after that date, if it's more beneficial to do so rather than to apply the 100%. So if we moving on to the next slide. So now we have this section 168N, totally new provision. It allows 100% depreciation deduction for what's called qualified production property. So it's non-residential property that is used by the taxpayer in a qualified production activity. And that basically includes, like a manufacturing, production, or refining activity of what's called a qualified production property. It seems to be kind of limited to the agricultural and chemical areas. And one provision that affects this is it's not going to be used, or it's not applicable if it's for food or beverage that's prepared in the same building as a retail establishment in which that same property is sold. So I guess for grocery stores, if they're making their own bread or whatever, it's not going to apply to that situation. And the uses of the property have to begin after January 19th, 2025, and before January 1st, 2029 again, as we can see that what I would call the January 20th date. And it couldn't have previously been used in a qualified production activity between January 1st of 2021 and May 12th of 2025. And then there's also some items that are not included. Property is used for offices, administrative services, research activities, software engineering, and other non-production activities. So they're really confining it to property, the non-residential property that is actually used in the process itself. So on our next slide, what we're showing is that approximately a third of the states conform to the federal bonus depreciation allowance under 168K. And if you look at the flip side of that, that basically means that 2/3 of the states don't apply that provision. So you already have a lot of disconnect under the 168K provision. So in those states, the act changes may not have an immediate effect in fixed conformity states, unless they go and they go about changing it. And there may be many responses to how the states may change it. Some may consider that good policy and want to adopt. Some may not want to do so because they're losing too much revenue. And, based on all the issues that we talked about previously and the budgetary constraints that, the states may run into in the next few years. So on the next slide, what we're going to do is we are going to basically kind of recap what these provisions are. So when people think about these issues, I think what you need to think about is, kind of thinking back to that slide that showed the rolling, the fixed conformity, and then the selective conformity. Those are kind of the buckets in which you need to think about this preliminarily, and then based on any types of changes that the states may come up with. But most likely, those are not going to happen immediately. So for section 179, you've got a rolling conformity state. You're going to continue to have, that increased deduction, just like you did on the federal side. If you have a fixed conformity state, they may have a lower limit. You may need to continue making adjustments. And you may have different types of adjustments for different states, depending on what amount that they set for the 179. So that may make it even more complicated because now you're having more variations. For the section 168K bonus depreciation, as we mentioned, there are a large number of states that have chosen not to conform to the existing bonus depreciation regime because of the negative impact. And for those that have not adopted it, you may not see much change. They may just continue to do what they're currently doing. And then finally, we get to I think one of the more interesting issues, which is the 168N, is what's going to happen with that provision. We've talked about how a large number of states have decoupled from 168K, but they may not automatically decouple from this 168N provision, and you may need legislative action. And just to give an example, I'm based in Illinois. Illinois' provision specifically references bonus depreciation under 168K. So therefore, they would most likely need to do something legislatively to change that approach. So those states that have conformed, as I mentioned, may need further legislation to deal with this provision. And then, as was mentioned earlier, Colorado, which is actually a rolling conformity state, was one of the states that estimated that impact, and they thought that the impact was going to be a negative $70 to $95 million. So we're going to go to the next slide, which I believe is a polling question.
Yes, thank you so much, Karen. Which OBBA provision do you expect will have the greatest impact on state income taxes? A, research and experimental expenditures. B, business interest expense limitation. C, bonus depreciation. Or D, other. And Karen, it's hard to see the statistic that Colorado shared in estimating that the new 168N was going to cost $70 to $95 billion to the budget. It's hard to see that and not think that that's a prime candidate for an answer here. Obviously, states that are very manufacturer heavy are going to see even more of an impact to their budgets by that provision. So this will be very interesting to see how the responses come in, and obviously as the dust continues to settle on the new law, where things rest once it's all said and done. So very interesting to see how that shakes out. So it looks like our results are in. And people seem to agree that bonus depreciation is going to have the biggest impact. So again, we'll see what happens, but certainly a very educated answer.
So Michael, let's move over to the international provisions, coming back to that side. And again, we're taking a holistic look at state tax matters from this, but let's step back for a second. I think everybody got used to the GILTI and FDII language. And beginning after 12/31/25, the regimes are going to be switching, as our arrows show. And it's going to move over to NCTI, which is net CFC tested income. And then on the FDII side, you're going to move over to terminology for foreign derived deduction eligible income. So that's how that is moving. And you can see the rate, the deductions going from 50 to 40, the rates going from 10.5 up to 12.6. And you can see the rest of the slides. And there's a lot of provisions because, again, we talked about it at the beginning, especially on the corporate side. The states normally start with the federal taxable income. So, and then start making adjustments and movements from there. A couple of key things, and I want to set some parameters here around some of the differences that are going on between GILTI and the new terminology and the new piece from the act. And the 40% is going to be permanent, and it's going to be beginning after 12/31/25, which I alluded to. It removes all allocation of interest, R&D deductions for the foreign tax credit purposes. Directly allocable expenses still are allocated. Now, both FDII and GILTI are going to eliminate adjustments related to qualified business asset investments, so the QBI. So just bear that in mind. So there are some nuances, and it reduces the foreign tax credit haircut to 10%. Now, that's for the GILTI side. So that gives you a little bit of taste that there are changes moving through this. Now, on FDII, same start date, 12/31/25. After that, removes the allocation of interest and R&D deductions. Other allocable expenses, though, are still allowed for FDII. And that's going to be interesting. And we'll get to why these are going to be critical components. And we've been talking about conformity, and the states are going to be looking at how they want to conform with this. It carves out the sales or dispositions of intangibles and property subject to depreciation. So there's a number of things going on. There are some corrections that are being made now through this approach, and some modification pieces that are happening. And, what is important here when you think about Subpart F and the Internal Revenue Code is the vast majority of states have adopted the state treatment of GILTI as a dividend. Now, what the state reaction is going to be very interesting. But what we're starting to see from the states, from legislative discussions and sessions and working groups, is the states looking at considering increasing the tax on GILTI. And that's probably not going to be a surprise. They're again trying to hold budgets and keep their policy in line with each state. And I always like to share, doing state taxes is almost like working with 50 different states or 50 different countries inside the US. They all have different focuses, things they want to move towards, and other aspects. In states that have a GILTI dividend, the changes actually may increase state taxes. So just bear that in mind. Additionally, the 40% deduction for the NCTI is going to change from the 50% GILTI. And again, that's going to impact a minority of states that conform to the Internal Revenue Code currently under 258A1B. So when you think about that, so what's this all mean to us from a state standpoint? You're going to see taxpayers benefiting from the FDII deduction may see changes to their state tax benefits. And in a few cases, it's going to really depend on how they conform to the regime. And that's really going to be what's going to drive this. And, as we pause and we look at it, it's going to have some nuanced changes. One of the big concerns is states that are fixed conformity. As painful as this is going to sound to everybody, it may require a pre-act GILTI FDII calculation and then a post-act NCTI and FDDEI for state purposes. So that's yet to be told, but again, it's all going to depend on internal revenue conformity dates as they're advanced from the state standpoint. So we really do expect to see a lot of pieces around the states, and the states may not be the biggest thing driving your business, but it's going to be important to understand the nuances here. Currently, a majority of states with the FDII deduction allow the FDII deduction in some form. So that's a key component. And when you think of that, what does that really mean? In both rolling and static conformity states that require separate company computation of the FDII deduction, differences may also exist from the deduction computed for federal purposes under the consolidated return regs. So what they're saying is you're going to have some adjustments that are going to have to be evaluated with regards to FDII. And the differences in static conformity states between the computation of FDII and the updated FDDEI amount, that's a mouthful, by the way, would increase the complexity facing taxpayers. And in essence, this is going to, and just remember back when GILTI and FDII came in play, it did create some complexity issues on the state side. It'll do the same. I think once the states go through legislative sessions, once the states kind of settle in on where their budgets are going to be and how they're going to work with the numbers, then you're going to see some continuity start to come into play moving forward. So that's high level what we anticipate happening on the state side. So, Michael, if you want to wind the slides forward, we left it here because we felt as though it was a better talking point. But you can, yep, one more. There we go. Michael, I'll turn the poll over to you. And, I really appreciate everybody being patient. And I think it's really important. Let me just add this in, Michael. I think it's really important to think about the patience that's going to happen because you're not going to know all the answers in the short term. The legislative sessions have to happen. The states have to evaluate everything. They're going to be looking to see when and where budget shortfalls may happen. So there's a lot of moving parts before the state piece is really going to be the dust settles and we have a lot of clarity. So, Michael, I'll turn it over to you on the poll. Sorry about that.
No worries, Mark. That's a point well taken. So yes, we are at our next polling question. Are you benefiting from the PTET regime in your state? A, yes, B, no, C, considering it, or D, not applicable. Just as a brief aside, now that the bill did not negatively alter PTET, and now that we're dealing with a permanent SALT cap, more than interested to see whether we finally get some additional guidance from the IRS on PTET beyond notice 2020-75. They have been extraordinarily diligent and meticulous in getting tax reform related guidance out since July. I've been very impressed. So wondering if this is going to be among the projects released in the near future. So it looks like most of our friends are residing in areas where the PTET is not currently available, but interesting to see that for sure. So we'll talk a little bit about that more now.
All right. Thank you, Michael, and thank you everyone for joining us today and for sticking around till the end. So one possibility with the OB3 and really to extend a lot of these provisions in the TCJA, like the QBI deduction, things that were really beneficial for a lot of taxpayers, was how do we pay for a lot of these things? And the SALT cap that came in with the TCJA was probably one of the most contested things, I mean, in that act, and definitely was, even something in tax related that made it to mainstream news. Like even a lot of people outside of the tax profession knew about what the SALT cap was. So in order to possibly lift to a higher number, that SALT cap, and maybe to get some, members of Congress from some other states that had high state income tax rates who were opponents of the SALT cap to begin with, maybe on board. The possibility was kind of thrown around of maybe limiting states' abilities to have these pass-through entity tax regimes that many states, as we'll see in the next slide, a map of 36 states that since the TCJA SALT cap went into effect in 2018, established these regimes where a pass-through entity like a partnership or an S-corp, which normally would pass through its income to its partners or shareholders and have that income reported on their personal returns and paid personally by them. Established regimes where these entities typically that wouldn't be subject to tax, like a C corporation, could voluntarily elect to be taxed on their income earned in the state. And so this was established as kind of a workaround to the SALT cap, because the SALT cap still was only a measure imposed on individual taxpayers and not businesses. So if these pass-through entities elected to pay the income tax of their owners at the entity level. They could take it as a deduction on the federal return. And so the owners at the federal level would have a reduced amount of income distributed to them that they would report at the federal level. So it was just a way of kind of circumventing the deduction at the individual level that was subject to the $10,000 cap. And so what happened is the IRS issued in November 2020 this IRS Notice 2020-75. And at this point in November 2020, about 7 states had enacted some kind of pass-through entity tax regime since the SALT cap went into effect in 2018. And so it may not have been like a full blessing and endorsement from the IRS, maybe just an acquiescence of just throwing their hands up and saying, this is okay, we'll allow this as long as it fits within the tax that's paid by the entity within these certain parameters. We'll allow the deduction and respect it. And that's where you kind of just saw the floodgates of state legislation open up. And just a matter of a couple of years, you went from 7 states to 36 that passed these pass-through entity regimes. It was almost unprecedented how many states could get on board with one kind of idea in such a short amount of time. But kind of always hovering above was that, I mean, really Congress and the president with the stroke of a pen could, enact legislation to just cut these PTE regimes that these states established just off completely. I mean, certainly there was a lot of tax revenue not received federally that was expected out of the SALT cap, because really you had these state PT regimes circumventing it, not for all taxpayers, but at least for owners of pass-through entities. The possibility was always out there that, Congress could enact a law to cut these regimes off completely. And so, at various drafts between the House and Senate, the OBBA kind of tossed around some ideas of really limiting these state PT regimes. The House bill had, proposed an idea of certain specified trade or businesses, much like the 199A deduction. Those kind of businesses, like professional businesses, law, accounting, healthcare, doctors, that wouldn't be able to take advantage of the PT elections, or the entities wouldn't be able to take that deduction. The House proposal or the Senate proposal is a little bit different at a couple levels of 40,000 or 50% of the PT tax, but ultimately none of those survived in the final version of the OB3 that was passed. There was at the federal level basically no modification to IRC 164 that was in place, and basically leaving the states to continue on with these PT regimes as they had them. So next slide, please. And so this map is where we kind of stand currently, the footprint of states that have PT regimes. So you have 36, and even New York City is the one locality there that since 2018 established a pass-through entity tax regime. And so you're really only down to 5 states and Washington, D.C. As jurisdictions that impose an income tax on individuals that never enacted a PTE tax. And so Pennsylvania, Vermont, a few have actually introduced bills that never ultimately got passed in prior years, but we could see now that with the SALT cap at least going until through 2029 now, that we could see some of these states actually enact some of these regimes, like Pennsylvania, that surprisingly just never enacted them beforehand. So I guess it remains to be seen then if the $40,000 limit has any impact on that. We would kind of expect that some of these states, Mark mentioned earlier, that had a mechanism in the way that their original legislation was drafted, that their PT regimes would end after 2025 to coincide with the sunset of the SALT cap originally in the TCJA, that we would expect most of those states to extend those regimes that they had enacted, but and some have. Virginia in May passed a bill that extended it to 2026, so one more year. But just this was before in July when the OB3 was passed, so maybe they just extend it for another year just to see where things go. The federal bill, California in June passed a bill to extend theirs through 2030. So a few states have taken action, but we still have a small number of states that would need to do something to continue it past 2025. So we would still expect, even with a higher cap, maybe less taxpayers taking advantage of the PT elections, but because they already have these regimes in place and have already kind of navigated some of the administrative difficulties, that we would expect to probably see those continue. Next slide, please. And outside of the PT tax, some other individual provisions of the OB3 impacting state taxes. So the IRC 199 Cap A deduction, the QBI deduction, this was another thing that would have sunset in the TCJA that the bill was able to make permanent now into the tax code, so that limit still remains in place at 20%, but was expanded with a little bit higher of a phase-in range, but otherwise still looks pretty similar to where it was before. Certain specified trade or businesses are still kind of potentially limited with that deduction. The excess business law losses limitation under IRC 461 was also made permanent and largely kind of similar to where it was before. They still kept the provision that any excess losses could still be carried forward as an NOL. One main difference besides just becoming permanent was that it would the $250,000 cap would be indexed to inflation, but otherwise it's still fairly similar. Another very good tax benefit, the IRC Section 1202 exclusion for qualified small business stock, was also made permanent and then expanded a little bit for a wider reach of potential businesses and exclusion amounts. So that exclusion amount went from 10 to 15 million. Also, they kind of phase in, instead of a 5-year holding period for the stock, to have the 100% deduction, a 3, 4, and 5-year phased in of 50%, 75%, and 100%. So potentially, a shorter holding period, which might help, for some taxpayers that may not have gotten to 5 years previously, but could still get something. And the big one here, the SALT deduction cap, a balance was struck. I guess it probably would have been too expensive to fully let the SALT cap sunset for some of these other things to pay for. I think the Joint Committee had estimated somewhere like a $1 trillion cost over 10 years if they would have let the SALT cap sunset. And so allow taxpayers after 2025 to fully take a deduction if they itemized for their state and local income tax expenses. So, as expected, a balance was probably struck there that we wouldn't go back to a full deduction, but somewhere in between of a higher cap, which was kind of expected. So now up to $40,000 for married filing jointly taxpayers, or 20 for married filing separately or single taxpayers. With some phase out, about 500,000 for taxpayers of their income, and then we'll revert back in 2030 to $10,000. So, like many of the other TCJA measures that became permanent in the Internal Revenue Code under this bill, the SALT deduction cap was one. You still kind of kick the can down the road a little bit. So you're going to see it at least for 5 more years or so, as it more or less kind of was before, but just with a higher cap. All right, next slide, please. All right, and some other individual provisions of the OB3 that once again we see the higher standard deduction and the phase out or disallowance of the personal exemption because of this higher standard deduction that became permanent going forward. The mortgage interest expense deduction made permanent, but eliminates deductibility for equity loans. Limiting amount of casualty losses that can be deducted, that became permanent, but with a little bit of an expansion there, not only for federal disasters, but any kind of state disasters. The bill continued the elimination from miscellaneous itemized deductions. So that was a measure under the TCJA that was suspended, but this bill made permanent. So this was subject to a 2% of AGI floor, various things like unreimbursed employee business expenses, and various expenses related to investments, but like management fees on certain investments. That was probably one more known thing that would have been a miscellaneous itemized deduction, but except for the TCJA, temporarily pausing it, and now the OB3 just permanently eliminating it. And then a new limitation for taxpayers on the amount of deductible itemized deductions, which the TCJA paused, but previously you had something called the PEAS limitation before the TCJA that was a little bit simpler, and PEAS was the member of Congress that had introduced the bill originally, but that was before the TCJA even a certain limitation for some taxpayers on the amount of itemized deductions that this bill kind of introduced a new, maybe more complicated way, but not that, something like this hadn't kind of been done before. Next slide, please. And then outside of things that were made permanent, extended further from the TCJA, things that are just completely brand new affecting individuals under the bill are the deductions for tip and overtime income. So why not fully just making tip and overtime income non-taxable? At least the bill created these deductions, and all of these deductions here that you see are above the line deductions. So even your taxpayers don't have to itemize to take advantage of these deductions. Taxpayers who take the standard deduction can still take advantage of these. So you have the tip and overtime income deductions, a new senior deduction up to $6,000. And for car interest, deduction up to $10,000 for certain personal use passenger vehicles that were assembled or in the US. So one limitation to it is you have to substantiate with the VIN number of your car in the tax return to take advantage of it. So by the VIN number, fun fact of any vehicle assembled, manufactured in the US will have a VIN number starting with 1, 4, or 5. So there's a way of being able to tell based on the VIN number you have to provide to take the deduction. But this will be for any any loan debt incurred starting in 2025 for a vehicle for personal use. So next slide, please. Oh, and here we are at our polling question number 4, right on time.
Yes, thank you so much, Tony. And our last polling question of the day, do you want someone from Cherry Beckert to reach out to you to discuss the topics that we covered today? Yes, no, or maybe once you've had a chance to catch your breath in a couple of months down the line. So with that, that concludes our webinar for today, and it concludes our Tax Horizons series. We hope you have found this discussion as well as our previous installations helpful, but please don't hesitate to reach out to us if you have any questions that we can assist with. Thank you again so much for joining us. We really enjoyed our discussion today and appreciate you joining us. And we very much value your feedback. And if you could be so kind as to respond to a short survey, that'll be coming your way in just a moment after you leave the session. So as a final reminder, recording and slide decks will be circulated in just a little less than a week. So thank you again, everyone, so much for joining us. Happy to be getting you out of here right on time. And we appreciate your audience. Thank you again and take care.